Hello and welcome to the Look Ahead with me, Fiona Cincotta, Senior Market Analyst at City Index, looking ahead to Friday, the 17th of January. So if we just have a look, we'll be starting off tomorrow. As you read this or hear this tomorrow, we've got GDP data from China, as well as retail sales and industrial production, which will be released overnight. In the European session, we have Eurozone inflation data. We also have UK retail sales, and this is followed in the US by housing starts and industrial production figures. So we're just going to focus a little bit on the UK. The UK has had a very big week this week as far as data is concerned. We had inflation data, which unexpectedly cooled to 2.5%. We had GDP data today, which was actually weaker than expected, rising just 0.1%. And tomorrow we have retail sales data. Now, retail sales are expected to rise 0.4% month on month, but we'll see whether that actually occurs. Now, this is really interesting because if we just have a look at what's going on with the FTSE here. This is the chart that I've got pulled up at the moment. We can see that it's breaking out of range. So it's been trading within this range, capped on the upside by 83.25 for quite some time. And above that, we've got the next level at 8,400. Now we can see we're getting this breakout towards 8,400. Now, basically what's happened across this week, because we've had this weaker than expected growth data, we've seen a tick down in inflation. Markets are actually reviving Bank of England rate cut expectations. So at the start of this week, the market was pricing in just one rate cut for 2025 from the Bank of England. Now it's trading in, it's pricing in 2.5 rate cuts from the 2.5 rate cuts of 25 basis points across 2025. Now, obviously, that's still a little bit below the 4 rate cuts that the Bank of England had guided towards. But I think, if we get more weak data tomorrow from retail sales, then that could increase those rate cut expectations further, raising concerns over the growth outlook in the UK. As I said, GDP data today was disappointing at 0.1% growth. That came after 2 straight months of contraction of 0.1%. So as we get those expectations of potentially another or more rate cuts from the Bank of England, that does mean that we're seeing some weakening, or we've seen the pound come under pressure, although it has picked up from the lows that we saw earlier in the week. But the pound is still under pressure, helping the multinationals, but also just optimism surrounding rate cut expectations is helping the FTSE 100 and more so the FTSE 250 push higher. The other one to watch, obviously, the FTSE with the Chinese data overnight. We get some stronger than expected GDP figures from China and industrial production, that could help the resources sector. So we could see miners and energy stocks push higher. Obviously, disappointment from China could see those stocks come under pressure. Retail sales, there's obviously going to be some influence onto the luxury retailers across luxury brands across Europe. Burberry in the UK, not on the FTSE 100, but FTSE 250. And also, I mean, that'll come, the data comes as we saw a really strong rebound in luxury stocks today across Europe after some upbeat numbers from Richemont. So just as far as levels to be watching, 8,400, next level to be watching on the FTSE. After that, looking up towards 84.80 all-time high. Momentum suggests there's still some upside to go. That really strong, and we've got that engulfing candle there, which is breaking through that 83.25 levels is also an encouraging sign. So yeah, 84 on the upside, 8,400 on the upside. Downside support 83.25, as I said, and then you've got the 200 SMA at 82.25. But really, to get sort of, the bears taking any sense of control, you'd need a break below that 81.50, which has been a level, again, that's been quite important over the past 9 months. Now, just whilst we're talking about UK retail sales, let's just take a look at the pound US dollar. So as we can see, it's been trading in a downtrend, the pound against that US dollar strength that we have seen on expectations that the Federal Reserve will not be cutting to interest rates perhaps as much as was initially expected. That caused the US dollar to strengthen to a 2-year high against its peers, and obviously with Trump coming into power as well. But on the pound side of this, we've had that weaker data, we've had those concerns that the of stagflation, particularly. We've seen those yields in the US, the gilt bond, the gilt yields were particularly high. They've steadied now. We're seeing some stability back in the bond market, which is helping the pound to recover from that low that we saw of 121. Now, if you have a look, I pointed this out before, the long lower wick on that candle, it's a hammer candle, which at the bottom can signify a reversal. Looks like we're just sort of having some thoughts about that, where we are trading just above that 122 level. If we do get some weaker data, which does support further rate cuts from the Bank of England. We have been seeing the weaker data and the lowering of inflation expectations actually pull gilt yields lower, which has been beneficial for the pound more recently. So it'll be interesting to see what reaction we'll get from the pound if we get the weaker retail sales in tomorrow. Will that help the pound push above the 123 as those gilt yields come back down? Obviously, we do have US data as well. That's something to be watching out for. If we get some stronger US housing starts, then obviously that could also have a negative effect on cable. Levels to be watching out for, as I said, on the upside around that 123. So 123, that's the low we saw back in April 24 last year. Got to rise above that. That's going to bring 125 into focus, the round number. On the downsides, you need to get a break below the 121 in order to create a lower low. That opens the door to 120.50 and 120, the round number. Let's also just have a look at what's going on in the DAX. The DAX trading at all-time highs. Now, this is really interesting because obviously this is happening just days before the inauguration of Trump, where there is potential that he will be applying trade tariffs to Europe, and German automobiles makers are obviously in the firing line there. But still, we've seen the DAX rise to all-time highs, and this is basically on the back of expectations that the ECB will continue to cut interest rates. We had the minutes from the ECB meeting today, which suggested that the inflation target will be reached sooner than initially expected. We've also had encouraged upbeat sort of earnings, which has helped numbers or helped sentiment across Europe. So levels to be watching out for. We've got Eurozone inflation tomorrow. It's expected to tick higher. Similar to what we saw with German inflation. We have seen sort of German inflation, particularly core inflation, rose 3.3%, up from 3%. So that does just bring concerns of stagflation into the picture, particularly in Germany, where there is weak growth. But still, the fact that the ECB are expecting to cut rates means that they don't see too many problems with inflation, at least over 2025. They expect to be cutting rates around 4 times this year, with the next rate cut expected at the end of this month. Levels to be watching on the upside. Next one will be the 21,000 round number. As we've broken above here, the 20,500 December high to bring that 21,000 into focus. On the downside, immediate support at 20,500, but then we've also got this level around here, which is the 19,750, sort of 19,850 between there, that support zone. Now, in order to get sort of bearish momentum, sellers would need to break below that level. I think it's worth keeping in mind a level of caution ahead of Trump's inauguration next week, as you know, we've seen that his comments can make the market move quite rapidly. So let's just finally take a look at Euro US dollar, see what is happening there. And again, in a similar picture to what we've seen with sterling, it's picked up from that lower level, from the low that we saw at the 101.70, 80, 101.80. That's the low that we saw on that US dollar strength. We've seen, as I said, it's not that I particularly think that the story for the euro is more bullish, but because obviously we've still got that divergence between the Fed and the ECB. The ECB are expected to be cutting interest rates on a consistent basis across this year. The Fed, not so much. The Fed themselves have said they only expect to cut twice. The market is only pricing in 2 rate cuts at the moment after the cooling in underlying inflation helped the market to reassess Fed rate cut expectations, because prior to that data, the market had only been expecting 1 rate cut. So yeah, levels to be watching. If we get hotter than expected inflation, may help the euro just pick that little bit higher above that 103.20 level, which was the November high. But as I said, gains are going to be limited in the euro, given that we know that the ECB is expected to continue cutting rates. It would take a sustained move higher in inflation, I think, for the ECB to rethink their position. On the downside, 107.80, as I said, but we've got that hammer position, not quite as acute as in the sterling US dollar, but it's still there, and that can mean a reversal, bullish reversal. So on the upside, if we get above that 103.20, then we'll be looking for 104, and then this level here, 104.70. That's the high that we saw just at the end of December. 104.35 is the January high. So a rise above there can help to create a higher high. So thank you very much for watching. I hope you've enjoyed what you've seen. And if you do have any questions, then please do reach out to me. Otherwise, I will see you tomorrow. And here's the risk warning, which is following.